Thank you, Greg. Let me just, you know how you get on airplanes and they say if you're not going to Denver, get off the plane? Well, a little bit of a miscommunication. This session is on the role of economic institutions in economic growth and stability. We did that other one yesterday. Yes, they're related, but as they say in the vernacular, they ain't the same. So good morning and welcome, everybody. Thanks for joining us. As this economy recovers slowly after a near-record recession, the roles that economic institutions played, now play, and will play have never been more important to all of us as citizens. The balance between a laissez-faire approach and an approach that includes some degree of government regulation, that's not a new topic, but it's never been so prominent in the economic conditions we look at. We've seen unprecedented bailouts, capital infusions to all manner of institutions, banks, insurance company, government entities, car makers. There's been forced consolidations, collapse of long-standing financial institutions, record declines in housing prices, and on and on. So all of these are striking indications of the stresses on our financial systems and, most importantly, its institutions, the underlying economic institutions. The financial and economic institutions have always played a major pivotal role in the smooth functioning of our successful economy, yet they played sort of a different role this time in the recession we face. So there's a couple of key questions. On the private side, how much risk can and should be taken by these large institutions given that they're entrusted to play such vital roles? Was their understanding of the risks in excess of their ability to absorb, unfortunately, the downside of substantial risks? On the public side of it, public institutions, FDIC, SEC, CFTC, pick your flavor, the regulatory institutions, do they have the authority, the staff, the analytical frameworks to take on increasing roles? This is not easy stuff. So it's this mix of conditions that bring us here today to chat with you. All of our esteemed panelists in the past 2 years have made important public comments about changes that they see and suggestions that they have for modification to the role of regulators in the economy. So with that, let me just make some brief introductions, and we are so fortunate to have a panel today that is so steeped in these topics. I'm not sure you could top this in the big tent. So let me start on my immediate right. Dr. Alan Greenspan, the 13th chairman of the Federal Reserve, having served 18 years in that role. Prior to that, he was chairman of the National Commission on Social Security. He was chairman of President Ford's Council on Economic Advisors, a board member of at least a half dozen or more multinational corporations, honored by France, certainly the United States, and the United Kingdom, and runs his own economic consultancy. On Alan's right, David Rubenstein, the co-founder of the Carlyle Group, a private equity firm that manages over $100 billion of assets from approximately 30 offices worldwide. David is the chairman of the John F. Kennedy Center for the Performing Arts, president of the Economic Club of Washington, D.C. I get to see him at lunches there occasionally, and it's quite interesting if you've not jumped in that. He's a regent of the Smithsonian Institution, a board member and trustee of multiple universities, including his alma mater, Duke University, a lawyer by training, counsel to the Senate Judiciary Committee, and a policy advisor way back when to President Jimmy Carter.
Well, you forgot to mention I got inflation to 19% in the Carter years, which nobody else on this panel can take credit for doing. So whenever I talk about inflation today, I have a lot of credibility there.
David, I was trying to work this the other way. I think you probably...
Inflation's a good thing. We need it.
All right. And on the far right, Robert Steele, who certainly those of you who are familiar with the Aspen Institute know is the chairman of the Aspen Institute. He currently holds a position as the Deputy Mayor of New York City for Economic Development. Prior to that, held a significant post in the Treasury Department as Undersecretary for Domestic Finance. And his original career, 30 years at the investment bank Goldman Sachs, ultimately becoming the vice chair. So I don't think we're going to get any better than this on this topic. So let me start out with I'd like each of the three of them to give us some of their views. We intend to open this up so you can have at it. That's the beauty of a place like this. The ideas are all over the room. So I thought it was a rare opportunity to ask Dr. Greenspan to frame this from the perspective of our financial systems, the roles institutions, economic institutions have in it, so that we get the right kind of context, both back in time and current. So, Alan, if you would, please.
Just want to make sure it's working. It's working.
Testing 1, 2.
Testing 1, 2, 3, yeah. I think it's important to realize precisely what the role of finance is in a market economy before we go further. Finance's purpose, and fundamentally its sole purpose, is to direct the scarce savings of a society into the most productive physical assets that it can create by financing. And that means that you will get a high level of productivity which parallels the standard of living. So a financial system that functions well is a very extraordinarily important contributor to our standards of living. Looking at the United States financial system as it evolved over the generations, and throughout especially the post-World War II years, there is very little doubt that we've had an extraordinarily efficient system. And the way you can tell is that everyone is concerned about the level of savings, which is inordinately low generally in the United States, but it is so productive. Every dollar matters. If you look, for example, at China, they save a hugely larger proportion of their gross domestic product than we do. Yet their standard of living is nowhere near ours, and the reason essentially is a very large part of their savings is wasted. You know, those buildings we see in Beijing, which are see-through, that's the characteristic of wasted savings. The American system broke down badly in the aftermath of the Lehman default, and depending on how you interpret that event, it will set the framework for knowing what you do with your regulatory structure. If you believe it's the type of event which is going to happen every 2 years, you'd have one structure. If you believe, as I do, that it's a once in 50 to 100-year event, it's a different type of analysis. I think the evidence is very strong in the direction of the fact that the breakdown in September 2008 was the greatest financial crisis globally ever. That's not the same thing as saying it was the greatest economic crisis. The Great Depression of the 1930s was that. But there is no other evidence or instance in history globally of the short-term financial markets of an economy freezing over. There is one case in 1907 where the call money market shut down for a full day. But during the Great Depression, the markets remained open even if prices were extraordinarily weak. This is the first time we've seen such an event. And I would suggest to you that that plus a lot of other evidence says this is a very rare event, but rare events, when they happen, and they feel as though it's 100% probability. So I would suggest generally that we keep in mind first how we view this particular crisis, because unless we answer that question, our regulatory recommendations make no sense. What is it that you're trying to avoid? In my judgment, this particular problem could have been solved, and now this is in retrospect, by adequate capital. We have had extraordinary evidence of lack of capital in the system for years. If you have adequate capital, by definition, it will absorb all of the losses that are occurring. It means that the debt will never default. Any debt will default. That's by definition, actually, of adequate capital. And if your debt doesn't default, you cannot have contagion. And so the issue here is basically how you create a level of capital which is appropriate. We're going to talk a lot about these issues later on. Why don't I stop here and turn it over to my colleague?
I mentioned the Carter inflation, but let me make another Carter reference. I was also, unfortunately, for better or worse, one of Carter's debate advisors in 1980, and some of you may have remembered that debate. But in that debate, which was the only debate that year, we only had one debate, Ronald Reagan asked the question, I think David Gergen had given him that question, or maybe it was attributed to David Gergen, but there was a question that was really very effective, and it was, are you better off today than you were 4 years ago? And that question, I think, made many people think that they were not better off and probably led to Reagan's being elected. And so my question really is, are we better off today with the regulatory scheme we have and the economy we have today than we were when the crisis began in, say, 2007? My answer is that yes, on a regulatory basis, I think we are in better shape to protect against some of the things that led to the last problem, but we are not necessarily in better shape to protect against something that we don't foresee happening right now. In other words, recessions occur from time to time, but great economic calamities occur less frequently. But when they occur typically in areas that people didn't anticipate. There's a book that came out recently by Ken Rogoff and Carmen Reinhart called This Time is Different. And they went back and analyzed 800 years of economic data and found that over 800 years there were bubbles that come along and they burst. And every time people say we're going to fix this so it won't happen again, and it happens again. There's another area that somebody didn't anticipate. Today, I think if we were to have the same type of problem that led to our most recent economic crisis, I think the government is adequately prepared for that. But I can't say for sure that they're adequately prepared for something we don't anticipate. We don't know what it will be. You can't possibly protect yourself against any possible economic calamity. And if you look against economic calamities over the 800 years or so, they come in ways and areas you never anticipated. So I don't want people to sit back and say, all of a sudden, we've fixed everything by having Dodd-Frank. Dodd-Frank is a nice bill. It's very complicated. It's the Congress's answer to what happened. It's 2,300 pages. It requires about 200 additional studies and sets of regulations. It'll take many years before we really know whether it works or not. And we have to live in an economy before we know what all those regulations are going to be. Today, I think investors are feeling generally that the government is a little bit more restrictive than maybe it should be and a little bit more cautious than it should be, precisely because it's so worried about having another type of 2007 episode. But as I look forward, where I see investors are looking right now, I think investors are so concerned that the U.S. government is maybe overly restrictive in some ways, and the U.S. growth isn't so wonderful, relatively speaking, that they are spending more and more of their time looking overseas. And the emerging markets, which we'll talk about in some other panels, are becoming much more attractive to investors. And I think as we look at more and more capital leaving the United States, or more and more capital from other countries going to the emerging markets, you have to wonder whether these emerging markets will produce a problem down the road that could lead to another economic problem for our country. And that's the reverse of what we've historically had. Historically, when the developed markets, which are mostly Western Europe, United States, and Japan, when they've had economic problems, the problems were much greater in the emerging markets because capital was taken from the developed market investors and pulled out of the emerging markets. The emerging markets collapsed, and they began to be seen as very unattractive places to invest. Now the emerging markets are much more significant factors in the global economy, much more important than they ever were, and I believe that they will be places that are going to drive economic growth over the next 10 years or so. And so as more and more money goes into those areas, they are more likely to produce the kind of economic problems or crises that might affect us than our own investing might. In other words, I don't think we are in as much control over our own economic destiny as we were 10 years ago or 5 years ago or just a couple years ago. I think the emerging markets are going to be much more significant. And so as we look to whether or not we're going to have economic institutions protecting us, I think we have to make sure we look at international institutions as well, because what they do in policing and overseeing the investment environment, investment activities in China, India, Brazil, Russia, and so forth, are going to have much more of an impact on this country than anything we have to worry about in this country by itself. I just don't think our economy itself is going to be so dependent just on what we do, and therefore we're not in as much control as I wish we were. One final comment. I think that when we went through the crisis that we went through, many institutions in the United States didn't serve us very well, and some institutions served us extremely well. I think two institutions that did extremely well and enhanced their reputation. Very few institutions throughout this crisis enhanced their reputation. I think one was the Federal Reserve, because I think they stepped up to the plate and did some things that they really probably never thought they would do before, and I think they really did an enormously helpful job to the American people and the global economy in taking some actions that I think were very helpful in arresting the seriousness of the problem, and the Treasury Department. And I think the Treasury Department, led by Hank Paulson, who is in the audience, and by Bob Steele, did an extremely helpful job to our country in making sure that the tough decisions had to be made and were made. So I think of all the institutions we had in our country that we look to for leadership, those two probably did the most important things to help us get through this recession and this crisis better than we would have otherwise gotten through. Bob?
Thanks. Well, Alan and David have said a lot. Let me kind of maybe fill in a couple between the cracks, because they've said things I might have said. You know, the topic is about economic institutions, and it relates to stability and growth. And as both have said, we have a large economy. Since about 1870, roughly, we've been the largest economy in the world. And the way I think about this is that we can't choose what the institutions will look like. We know what functions they should perform, but these institutions will change over time, and markets will develop new business models, and trying to organize specific institutions isn't really the right idea, but it's instead, what would we like to have happen? We'd like institutions that basically, as Alan said, serve as an allocator of capital. We want our economy to grow at a stable and steady rate. We want stable prices. And we believe the combination of those two things will basically generate a high standard of living and high employment for the citizenry. And that's how we want institutions to serve the markets in our economy. So today, we know the types of institutions that are basically the important ones. And I kind of frame it in this way. We have large commercial banks. We have small commercial banks. We have insurance companies. And we also have investment banks. And we have asset management. And so those are the 5 activities, and most of the rhetoric has been focused on the commercial banks. And I think people feel as though they were a place that was not as well prepared and didn't respond as well to the punch in the stomach that the economy produced. And that was, and many people argue that they were responsible for it too. And the antidote to that seems to be either probably a combination of more capital and also adjusting the business model so there's less risk in the balance sheets. It's unclear how successful that will be. I think a group of people that have been discussed less well are the small banks. Maybe people know all this. We have about 7,000 community banks in the country, and they're about 20% of the assets. But they're more important than you might think just from that, because they're about 50% of the loans to small and startup businesses. So they really are close to the economy in terms of creating jobs. We know that small businesses are about 50% of the GDP of the country, but when it comes to creating new jobs, 60-70% is coming out of small businesses. So this alignment between community banks and generating jobs and growth, which was one of our core ambitions, is correct. So as I said, I don't want to prescribe what institutions should look like, but I think the right thing, the way I've tried to think about this, is what regulatory regime will produce the ambition or the outcome that we'd like. When I worked for Secretary Paulson in February of 2008, before the financial crisis was full-throated and really upon us, we talked about what we thought was the optimal regulatory regime. And Secretary Paulson instructed a group of us to work on this, and we really came away with 3 principles that we thought were the right things to be thinking about. One, we thought there should be some type of systemic risk regulator, someone who looks across everything. And this was a new idea at the time, and not everyone was in favor of it because it's almost a impossible job. But the idea is we have to think about how to apply that. And so the idea that we thought was the right way to think forward was to have some type of macro or systemic risk regulators. That was one plank of what we thought would produce the right outcome. The second plank was very strong what's called microprudential regulation, the group of regulators that supervise the banks. In this country, we have a regulatory regime that's been built over 75 years, normally in response to a crisis, with not an overarching thread, but more a response to a situation. And so we have rules on top of rules. And so today, you have 5 different regulators regulating banks. That was before you get to each state. And so we talked a lot about the idea of consolidating the prudential regulation from 5 to 1 or 2 was an ambition that we thought would give more heft, more skill, and a greater culture of compliance and stronger regulation. And the third thing we talked about was some type of consumer regulation, which has gotten a lot of traction, and I think we can see that's happening in Dodd-Frank. I don't think we had as much detail as exactly how it would work, and it wasn't as much of a political lightning rod, but in particular, we thought that there needed to be some effort with consumer protection. This is a bit weedy, but bear with me. This is a tough issue because we've always thought that the key issue for banks that should override everything is safety and soundness. And when you introduce consumer protection, you have a second ambition you're trying to solve too. And so balancing those two, where safety and soundness comes first, but with a consumer protection perspective is right. So what we see is if we have and think about those 3 goals as we outlined, then what will institutions they will produce? And I think that they'll adjust, and we'll see them adjust, and we've seen that in the last 20 or 30 years. We've seen when there were large numbers of independent investment banks, and today there are just 2 large ones. They've been absorbed into other models. I think the last point I'd make would be just 2 things that I think we don't have right and require a lot more work. And then I'll turn it back to Jimmy. One is the idea that I think that the whole mortgage area is something where we need to do more work. There are about $10 trillion of mortgages in the United States market, and it's very easy to talk about this with hyperbole, but it's a lot more complicated. The idea that some people say, well, we should just have everyone put 20% down and have full mortgages, 30 years, fixed rate, it doesn't really work, and it ends up causing really unattractive situations in the population where all of a sudden large numbers of people are disqualified from home ownership. So it sounds simple, but it's a lot more complicated than that. I think the second issue, besides the whole housing mortgage I just want to put on people's radar, is that we have a situation in this country where a large number of people are outside the banking system, and they're unbanked people, in particular people that are less well off. And that really doesn't work well for them, and we have to figure out ways to be more inclusive in the banking system. And this is for people that have incomes that are uneven, they make mistakes, they overdraw, and things like that. And we have to have simpler products that get these people into the banking system so they're not using payday lenders and not being having to be in very mean-spirited situations with regard to financial intermediaries. And the people that have done the most and I think the best work on this is there's Martin Eakes at the Center for Responsible Lending has written about this a great deal, but it's really a challenge that we haven't yet figured out. So let me give it back to you.
Thanks, all 3 of you all. What we'd like to do for sure is open up some microphones here to take audience questions. Not right yet, though. I knew when I did that the hands would go up, so back down, back down. We're going to put the stanchions up, but don't go to them yet. I did want to get one question going, and then after that, please, let's have some fun. We couldn't have a better group to answer your questions, but I've been extremely curious. I've read a lot of what you all have written in the last few years. This is not Chris Matthews hardball, this is softball, but I'm fascinated by the one dimension of this, and a couple of you touched on it, which is these are extremely complex things to figure out in general, let alone forecast and anticipate. Alan said it in terms of these are once in a 50-year, once in a century events sometimes. Who can predict that? Well, a key question then becomes, do the financial institutions on the private side as well as the public side, the regulators, do they have the data, the analytics, and the forecasting capabilities to give us that insurance and protection, or is it just, boy, that's a tough nut and we're getting better, but we're not there yet? All of you all deal with it in, an economic sense, an investment sense, and Bob, in all the above. Any comments on that?
Well, I think the first thing we have to do is to define what is a crisis. A financial crisis is, by its nature, a sharp decline in asset prices, which, as Bob points out, is unanticipated. I would say a necessary condition for a financial crisis is that it is unanticipated, because if it is in a financial system which is partially effective at least, that problem will be arbitraged away. I remember that there was a considerable amount of concern about our current account deficit as likely to be the cause of the next recession or crisis. Well, everyone agreed with that. So what happened was that the euro, which was at that point 110, got driven to, or I should say, the dollar-euro relationship. The dollar was weakened to the point over the next several years which eliminated the edge of the crisis, and the current account balance, that is the trade balance, if you want to put it in simpler terms, had very little to do with this crisis. But the most important issue here is that we are fooling ourselves if we believe we can forecast these things. And indeed, I think the systemic regulator is a beautiful concept. There's only one problem: we don't know how to do it, and it can't be done. I mean, I've been there, and I will tell you, it is not possible. The fact that you set up a group of people whose job it is to anticipate the next crisis, I would say, good luck. And if you, even look at what's going on now. I mean, the administration has got as good a set of analytical economists that I know, and you don't hear their names. They're just sort of beneath the radar screen, but they're always very good. If you look at the forecasts of this administration, and in fact every administration, and you score them as to how good they were, the bottom line is awful. And that is universal. So I think we first have to recognize, what is it can we do? What can you do? And that's the reason why I argue that regulation should be preventive, in the sense that if you have adequate capital in the system, I mean, if adequate capital existed in September 2008, we would have still had a bubble bursting. There's no way to avoid the bursting of the bubble, and I would even argue there's no way to avoid their creation, as Rogoff and Reinhardt demonstrated. They always pop up. It's human nature. You could see it happening in front of you, and it's like a nightmare, but there's no way to turn it off. The trick is, all bubbles by definition deflate. The question is, are the institutions which would be affected sufficiently capitalized so that they can absorb those losses? That is as good as we can do. The presumption, I will get into Dodd-Frank later, but I will tell you, Dodd-Frank is failing. And it is failing because it is requiring, for example, at the Federal Reserve, 200 rulemakings. A rulemaking is a very complex procedure which requires usually months sometimes. And when I was at the Fed, if we did 10 a year, that filled up our capacity to do it. They've got to do 200. It cannot be done. But more importantly, the conceptual structure on which Dodd-Frank is based and its implications as to how the regulations would impact on the financial system, to me, are frankly naive. And what I'm worried about is when they try to implement them, they will fail. And there have been innumerable instances immediately. Remember, for example, when Dodd-Frank was signed, the first thing that occurred was that Ford Motor Company, through its credit, Ford Credit, tried to issue $1 billion in asset-backed securities to finance sales. But part of Dodd-Frank had a little sentence in it that there were certain conditions under which the credit agencies would be subject to litigation based on their recommendation. So what happened, Ford Credit could not get a credit rating agency which by law was required for an asset-backed security. So what happened, everyone scrambled around, and the staff of the SEC indicated that it would not recommend to the Commission the implementation of this particular part of the law. Now, to this day, I don't understand the legal basis upon which they were able to do it, but they did it, and of course, the actual $1 billion was put in the market, and it did its thing. Most of those rulings are supposed to occur or be completed by July. There is absolutely no way that that's going to happen. The deadline is going to be missed in almost every single instance. And I think we've got a problem here which requires attention, but at the moment, the markets are adjusting. I mean, capital ratios are rising very significantly. That's the only thing I look at. That's the thing, to me, which is the greatest protection. And I think probably at the end of the day, with the exception of fraud and any of the aspects of fraud, which incidentally is wholly inimical to a market system, that aside from that, I'm not certain that we actually could do more that would be effective.
I just respond and say that Alan is incredibly consistent. I went to see him in January of 2008 with a colleague, Dave Nason, to talk about the things we were thinking about with regard to regulation, and he told us then, and he's repeated now, that he thinks the systemic risk regulators are a crummy idea. So we have a difference of opinion, but he's consistent. And you know, I think that he's raised the right idea that this is a very, very difficult responsibility. But this is a serious issue, and there was a group that met regularly, which was birthed from an executive order called the President's Working Group, and we thought it was best to try and organize some group of people who should have the responsibility for looking across all of the types of institutions. And I accept everything that Chairman Greenspan says about the difficulty of this job, but when we weighed the difficulty and the probability that it might not work or whatever, we thought this was an appropriate mechanism to try to have someone or some group of people whose job it was to look out over the economy and try to understand where there might be concentrations or whatever. But as Chairman Greenspan said, these things are unpredictable, tough to see, but that was our view, and he had a different perspective then, and he's repeated it again today.
It's often said that generals fight the last war, and I think regulators and economists often fight the last recession or last crisis. So we're really good now at getting ready to fight the last crisis, and if we have a subprime debacle again, we'll be ready for that. But we're not really ready for some other things. And the things that I think we're not really ready for is, let's suppose the most important people in the economy, who I believe are the people who determine our credit rating right now, if the people who decide what our credit rating is at S&P and Moody's decide today to lower our credit rating, I don't really think we're adequately prepared for that particular crisis, which I think will have an unfolding catastrophic effect on our economy if that were to happen. We're not quite prepared for that. But for the crisis we've had, I think we're okay and we're adequately prepared to deal with that one again. But we're never adequately prepared for the crisis that comes up because we're not really sure what the crisis is going to be. The major change that I think has happened in the overall economy globally between what happened before the crisis and now is that the American credibility to lead the global economy isn't what it once was. We used to tell other economies, here's what you should do, and here's how you should run your affairs. And then we got into these problems. People said, well, why should we listen to you anymore? So I think people around the rest of the world are saying, well, thank you very much, United States, for doing many good things for the world. Right now, we don't really want to take your leadership so much, and we're going to govern ourselves a little bit differently than you might want us to do, and we actually have some better ideas than you might have. And therefore, I think increasingly people around the world are going to be doing things that we might not like, that may be good or may not be good, but they aren't going to be things we necessarily would like, because I don't think we have the moral authority and the economic might anymore to control things. Last point I'd make in response to your question is, are we adequately, do we have the data that we really want? When you go to business school, you learn how to use data and computers. I didn't go to business school, so I'm not a captive of this, and maybe I'm negligent because of it. But people come to me all the time and show me economic projections for 10 years, and I ignore them completely. I think, unfortunately, our government, about 10 years ago or so, got into the habit of giving 10-year budget projections, which are, to me, meaningless. I mean, how many of you conduct your affairs on 10-year projections of what your spending is going to be? Probably very few of you. The government can't really predict 10 years in advance, and therefore I think we often get caught up in the idea that because we have all these wonderful numbers saying that there's not going to be a crisis, there will be a crisis, we can pay off our debt, we can't pay off our debt, we get captured by these numbers, and I think these numbers really are prisoners sometimes, and we're prisoners of these numbers, and we shouldn't be. I don't think it's really possible to predict things more than a year or so in advance, and I think we shouldn't get caught up in projections about what the U.S. economy is going to look like, or what our ability to do certain things is going to look like 5 or 10 years down the road. I just don't think we have the analytics or the mindset or the capability to predict that far in advance.
Great, thanks. All right, let's open it up to questions, please. There's microphones on either side. So I hate to ask you to stand there, but that's the way we're going to do this. Please.
Hi, can you please help me reconcile the difference between, on the one hand, trying to get Fannie and Freddie out of the mortgage markets or reduce reliance on them, and on the other hand, making it so difficult for the big systemically important banks to earn their cost of capital that they really don't have any incentive to re-enter the mortgage market?
I'll just say one thing as an opening, and Alan knows more about it than I do. The one thing that Washington has decided it cannot solve is Fannie and Freddie. They just don't have a solution. The solution is too expensive, too politically difficult, and everybody runs for the hills. There is no solution that's going to come out of Washington in the near time. We're just going to, in my view, let Fannie and Freddie continue to do what they do. We're not going to make major changes. We're not going to completely take them, put them out of business. We're just going to let them ultimately drift away. It's unfortunate, but the political cost of dealing with them is just too great, and I just don't think we have anybody in Washington wants to tackle that.
Anybody else?
You want to go? I'll go if you want.
Go ahead. Or we can go to someone, you know.
Go ahead.
The first thing we have to recognize is that the Fannie-Freddie model was doomed to disaster almost right from the beginning. And the reason I say that is that I remember, it must have been about the year 2000, when maybe 1999, when one of the senior staff of the Federal Reserve came up to me and said to me, Fannie and Freddie are going to bite us at some point. And for the first time, I really looked at Fannie and Freddie, and their model was very simple, that given the fact that about a 25 basis point subsidy was being offered by the private markets on the grounds that Fannie and Freddie would not be allowed to fail, and therefore they could be held as equivalent to a government-guaranteed institution. Everybody said no, and I was obligated to say when I went up for testimony that it says in the statute that which authorized Fannie and Freddie, that these institutions are explicitly not governed by the full faith and credit of the United States. When we used to have paper debentures, it was right on the first page. The markets hee-hawed and did not believe it, and they, of course, turned out to be right. But if you get 25 basis points in a functioning financial market of the type that we have, you have to be retarded or very incapable of doing anything in a substantive manner if you can't make a huge amount of money on that particular subsidy. And what strikes me about this is that what they did is they recognized this issue and knew for every dollar that they had in their portfolios, or more exactly, what they did was they would purchase mortgage-backed securities, and they were getting market rates of the mortgage-backs and the cost of debentures, which was 25 basis points less than the market, and their rates of return on equity, which incidentally was very small to begin with, were just horrendous. Now, the function of Fannie and Freddie was basically to assist in affordable housing. But what occurred as a consequence of that was, as we're now seeing, is a system which was destined at some point to fail because it was operating on a very thin margin. And it's $160 billion and continuing in the hole and with taxpayer money. And unless we staunch this bleeding, they're going to just continue to do so. Politically, it is almost impossible to touch these institutions. And unless and until we decide to fix them, and it is remarkable that we're allowing this very major erosion in red ink, which is at taxpayers' expense, to continue with no attempt to come to grips with it.
Did that person tell you where it was going to bite you? He didn't say. I can guess.
No. Please.
Barbara Fergus from Ohio. This is for Bob Steele. You talk about consumer regulation and protection. Will Elizabeth Warren be confirmed? And if she is, will that organization be effective? Because it's running right now.
Yeah, I'm not a political person and don't work in Washington. My impression with information is no different than yours. It seems as though the current perspective is the administration has used Mrs. Warren to develop the philosophy and get the organization going, but my impression is that they're moved on to someone else who will be the leader, and so I think that's point one, but I don't know any more than anyone else. Number two, there are real issues that we need to face with regard to protecting people from financial products, and we have lots of other safety mechanisms in our society that work pretty well, and so the idea of consumer protection is the right one. And as Alan knows, because a lot of this was originally in the Federal Reserve Board, the question is the balance. And so there'll be a debate and a dialogue where people will push from each side, and we'll see where the meter actually falls. My instinct would be that for a period of time, it seemed as though, especially prior to the last congressional election, that the meter might have been being set here, and now it's being swung back a little bit more this way. And so we'll just see how that unfolds, but that would be my instinct. But as I said earlier in my opening comments, that the idea of some type of specific consumer protection is one that I think is good, and that we talked about with our blueprint of what we thought regulation for the future should look like.
It's not clear to me anybody can be confirmed for that job currently. I just don't think the Republicans in the Senate will confirm anybody unless there's some changes in the statute. I just don't think anybody would be satisfactory to the Republicans in the Senate, and therefore I don't think anybody will be confirmed for that position in the near term.
Sir, please.
Aaron Podhurst, Miami. I would like to ask what I think is a Main Street question of the Wall Street people. without using hindsight, I have no doubt that Secretary Paulson saved Main Street by doing what he had to do. It would have been worse for Main Street and what occurred. What I don't understand is how we're going to stop what Dr. Greenspan said is one of the most important things, which is adequate capital. How can you know what adequate capital is when I believe, reading as a layperson, that people were selling products that didn't even know what they were selling, didn't know where it was going. AIG was insuring it. Rating agencies weren't doing their job, and they really didn't have a handle on what kind of capital you would need if anything occurred. So my question is, whether it's human nature, whether it's immoral, whatever you want to say it is, how do we stop it in the future other than by regulation? Thank you.
I think what you have to do is that put in regulations which specify the level of capital with the full understanding that the regulators or the legislators who determine that particular level are not guessing, but making very rough approximations. A level of capital in one generation could be deficient and create periodic crises. In another generation, that same level could be a misuse of capital. It's one of the most difficult things that regulators have to do. And indeed, look at what happened very recently. There's a group of international regulators, including the United States, which meets in Basel, Switzerland, under the auspices of the Bank for International Settlements, to set up an accord which every individual central bank signs on to. That accord, which was called Basel II, was ironically implemented just as the crisis was beginning. This is the consensus of a large number of the most sophisticated regulators in the world. These are the regulators of the in the central banks themselves. Basel II was obsolete within days. Now, if you run into that sort of problem, then the question is, do you err on the upside, recognizing fully that if you have capital which is too large, or if the capital requirement is too large, the efficiency of the banking system to do what I said at the very beginning, that is to channel the savings of a society into productive investment, is diminished. So that these are the types of trade-offs which require forecasts, in the sense that if you knew what was going to happen, you could define capital ratios to 4 significant figures. But we don't. And the fact that our forecasting capability is to a very large extent illusory, we're caught up in an issue of how does one make that judgment. I don't say I know the answer. I know how it is done. It is basically done in committee hearings on Capitol Hill, and they get it roughly right, but not always. And I think that the presumption that we'll get capital which will prevent the next crisis is itself, I think, an illusion. We can't do that. All we can do is to put in rough measures of adequate capital, of what we perceive to be adequate capital, because most of the time, counterparty surveillance on the banks is really quite effective, meaning they know what the people to whom they lend, they make judgments which probably are better than the regulators on the quality of the banks to whom they lend. And to the extent that the regulators, the Federal Reserve, relied very heavily on the judgments of the bank's judgment of their competitors, which was actually very useful for a very long period of time.
Please.
Chairman Greenspan, you mentioned yesterday that fixed asset investments at a 70-year low. And I guess liquidity on the balance sheets of these firms that usually invest is at an all-time high. Is the required rate of return that these companies normally need, is there a liquidity premium maybe that's been incorporated since maybe in 2008 they couldn't roll their paper over? So is there a liquidity premium now that's maybe embedded in these required rates that maybe a guarantee of money markets would alleviate and bring down and maybe kind of catalyze these firms to deploy that liquidity, knowing that they can go back to the markets and get that anytime they need? Would that spur fixed asset investment and job growth too? Thanks.
Well, the only thing, it's hard to know what you call what is going on, but what you cited is correct, namely that a very significant part of the diversion of the liquid cash flow, which is directed towards illiquid fixed long-term investments, that liquidity is spilling over unused as cash balances on the asset side of the balance sheet of non-financial corporations. I wouldn't call it a liquidity premium. I would just call it what the critical issue is the fact that the required rates of return on illiquid investments have, because of the extreme levels of uncertainty, risen to such levels that they essentially have blocked off a significant amount of cash flow towards non-investment. So non-investment, by definition, is either increasing liquid assets or paying off debt or a number of other things. I guess you could call it a liquidity premium, but I don't think that's a useful term. I think the cause and effect issue is the very high degree of uncertainty which works its way into the capital investment process and creates, as I indicated yesterday, the lowest level in the ratio of what liquid cash flow that corporations are choosing. Remember, it's a choice, choosing voluntarily to put into long-term assets. That ratio is at the lowest level since the Great Depression.
I think the reason it's so low is three reasons, in my view. One, companies have now, U.S. companies have, let's say, $2 trillion plus of cash on their balance sheet. They are very profitable. Corporate profits are reasonably good, and corporations are finding that they can get these high corporate profits with the employee base that they currently have. So hiring new employees isn't really seen as essential to growing corporate profits. They've learned to manage them more efficiently. Secondly, they feel that the opportunities are much greater overseas, and to the extent that there is investment now being done in fixed equipment and so forth and new hiring, it's being done overseas where the growth rates are higher. And three, as Alan said, the uncertainty about the U.S. economy's growth rate and regulatory environment has kept a lot of CEOs from wanting to deploy capital in the United States. And my fear now is that because we're getting close to a political season where people are going to make a judgment about whether or not there's likely to be a change in 2012, the people will say, well, if there is some prospect of a change in 2012, maybe I'll hold out and not make investments in the United States until I can see whether the regulatory environment, economic environment, the conduciveness to the kind of things we want to do is more favorable. And so I think you may find a further slowdown in deploying of this cash because of that situation.
We have time for one more question because I'd like to be able to hear some closing comments from our panelists. So please.
Thank you. Daniel Cass, North Carolina. I was wondering if the panel could address the issue of derivatives trading and the lack of transparency in it. We were told by many sources, Michael Lewis most prominently, that this was one of the key sources of the financial crisis. There's a proposal in Dodd-Frank to try to create a clearinghouse, but I think a year later the chance of it being enacted seems remote at best. My question is this, as David Rubenstein says, fighting the last war? Or is it the case that one of the key conditions of 2008 remains absolutely unchanged today?
Alan, you want to start?
Well, remember, in order to have a clearinghouse for derivatives, you have to have a tradable contract. There are always been clearinghouses when we go back to the old Board of Trade, trading wheat and corn and oats and the like. If you look at what they did, is they had a standard contract which was very explicit on issues of quality and the like, and they then showed very small alternatives, premiums, pluses and minuses to the contract. The major issue is that that type of restriction that existed in the financial markets and of necessity in futures, in all sorts of markets which trade, is what created the over-the-counter derivatives market, because it became more and more important to individual corporations who had idiosyncratic risk problems they wanted to balance. And I don't know whether you got involved in it, but Goldman, for example, would, of course, make a major market in actually taking on the derivative position, the alternative derivative position, and hedge it out in many different ways. But the point at issue there was the fact that that the individual corporations did not find it adequate to have a clearinghouse because it was too simple, it didn't hedge the appropriate risks. The bottom line is it is far better to have a clearinghouse than not to have a clearinghouse. The problem essentially is, can you convert over-the-counter derivative tradings to clearinghouses? And I would say only marginally. As the years go on and the technology improves and you find ways of trading bundles of products, maybe, but remember that these are trades in which people effectively have to get delivery or it doesn't mean anything. And the delivery is in what? And unless you define it very clearly, you will not get those markets functioning. So I think the answer is, if you can move it to clearinghouses, that's good, and it's a desirable goal, but it's far more difficult than I think the people who espouse the position understand.
I think Congress looked at it obviously in the Dodd-Frank hearings and the deliberations. They concluded it was too complicated for them to figure out a solution that was going to be better than the current situation. And so what you see is what you get for the next 2 years or so. You're not going to have anything coming out of Congress that's going to deal with it, in my view, in any serious way. It's basically going to be as it is now.
And at the margin, the more that you can encourage to go through a clearinghouse, the better it is. But that's not going to allow people to accomplish the expressions of risk management that they wish, and because everyone has a customized idea of what they want to do, and if the other side doesn't actually exist, then someone will have to create it for them, so it'll be a customized situation. But at the margin, the more that goes into the clearinghouse, the better it is.
Thank you. With the last 10 minutes, I think it's a fascinating opportunity to hear, much like we did at the opening, any closing comments that our panelists have. You know, what we've listened to is that this is we've been through a once in a 50-year, once in a century thing. It's still unfolding. It is not an easy fix. And we've been focusing on the institutional roles. I wonder if maybe in the closing, to take it even further, are there any other big surprises, not economically, but institutionally or directional headings that you all are thinking about or have had discussions about that we ought to be aware of? Or alternatively, just close it out with your best thoughts on this. So let's start with David, then Bob, and then we'll close with Dr. Greenspan. Okay,
the person who gave the initial introduction to this panel, to make him feel good, I will talk about the deficit so it doesn't look like he was completely wrong. This may repeat what was said yesterday, but I just want people to focus on this one thing relating to the deficit, put it in context. We have $14.2 trillion of gross federal debt. The net debt is about $9 trillion, but let's use the $14.2 trillion number. As we discussed, the Fannie Mae and Freddie Mac debt is really federal debt. It's really $5 trillion of additional debt. Now what's going on in Washington is an effort to cut this debt because we recognize that we can't sustain it Right now, the gross debt is about 93% of GDP, and that's a historically high level. We're reaching levels that are just not sustainable. So we now are talking about, as everybody's probably read, cutting the deficit a bit, and Washington is now tied up with Vice President Biden leading an effort that may or may not succeed in cutting roughly $2 to $3 trillion out of the debt. That will come from about $1 trillion supposedly from spending cuts, $1 trillion from interest rate savings, because maybe the interest rates will come down because we're saving money, we're cutting spending and deficits, and $1 trillion maybe from so-called tax expenditures, reducing certain tax benefits. But I just want to put it in context in case people didn't focus on this. What we're really talking about is we're projecting $12 trillion of additional deficit over the next 11 years. What we're talking about cutting out is $3 trillion out of that $12 trillion, which means we are going to get an additional $9 trillion of debt over the next 11 years. Add that $9 trillion to the $14 trillion, that's $23 trillion, plus the 5 of Fannie Mae, that's $28 trillion. So we're not really solving the problem, honestly. Now, some people would say as a percentage of GDP, we're doing better, but actually we're not. Even with this $3 trillion of deficit reduction, if we get it, we're still going to be at roughly around 110% of GDP in terms of debt. Government debt will be about 110% of GDP in about 11 years. So my whole point is the $3 trillion being cut, if it can be cut, is de minimis compared to what we really need. And unless we really are going to dig into the entitlements programs and other spending programs, we are going to have a very sad situation for our children and our grandchildren, because we just can't sustain this debt level. And I don't think we're really making big progress on it right now in Washington.
I'll go back to the topic of financial institutions, and I think I'd want to leave people with 3 or 4 thoughts. One, financial institutions do play an important role in what we're trying to accomplish, which is stable and predictable long-term growth and price stability. We need to have strong financial institutions. I think predicting exactly how they'll take shape or what they'll look like or who'll do exactly what really isn't our job. That should be determined by the marketplace. What we do need, though, are organized rules that people can follow and understand, that put in the appropriate cushions and in all of these different activities, because we can see by what we've been through, when these institutions have challenges and their stability is threatened, that the impact really ripples through the whole economy. So if you needed any verification of the import of financial institutions, we've just seen it. So the real issue for my mind is people working together in an enlightened, thoughtful way to think about what are the best regulations and the best way to think about organizing these institutions so then they can respond to the crises that come. And the way I thought about this and the vocabulary we've used are objectives-based, and they really were, as I said earlier, threefold. One, someone that thinks about the high altitude, what's going on across all of the landscape of all the financial institutions. Two, stronger and more focused and more professional people who are doing the day-to-day regulation of the institutions. And this means a culture change. It means more money, better pay, so that the people that have these important responsibilities are really the people that are capable and are a fair fight with the people who they're trying to understand and regulate. And lastly, we do need a more approach to focusing on consumer protection and thinking about those things. If we're better at these activities, then I think the prospects are that financial institutions can play the important role that Alan began by outlining in his first few sentences, and that's the important part of it. And hopefully people will get past the idea. You know, I went to Andrew Ross Sorkin and Joe Nacero's discussion yesterday or the day before, and one of them talked a bit about the understandable interest in retribution was the word they used. And I think at some point that's not helpful to what we're trying to go past and toward. And when we work through that, it'll be better, but it'll take some time.
Dr. Greenspan.
There's one trend that's going on in finance, both domestically and internationally, which in my judgment is not getting enough attention. It's the fact that in the United States in 1947, the national income originating in finance and insurance was 2.4%. In 2009, it was a record 9%. I thought that ratio would go down during the crisis. It did not. More importantly, it is an international phenomenon where a whole variety of countries across the globe are experiencing the same rising trend, including China, which has a very dramatic rise in its financial intermediaries, which is basically finance and insurance, during the same period. Not, I should say, since the 60s, really. We don't know whether, in fact, that increasing trend is a necessary condition to implement the division of labor that continuously expands and specializes as globalization gets ever larger, or more importantly, is it such that the complexity of economies in today's world requires more finance? Finance, incidentally, the data that I'm quoting are net, meaning that all of the income that finance gets in the United States occurs because non-finance requires their services. This is net of what a lot of people think the financial industry sort of sits there and generates profits and income for themselves. All of the income generated in finance is created because of demand coming from the non-financial sector of the economy and international, which at this stage is not that critical. But I don't know the answer. I've asked innumerable number of people who are most knowledgeable on the subject. They don't know the answer. But to see such a gargantuan phenomenon going on with huge implications of the future not being appropriately addressed bewilders me.
Except for private equity.
And that's going to be the last
too much
word.
private equity, right?
Ladies and gentlemen, join me in thanking our panelists. Thank you all very, very much.